The global slowdown is very serious. One may mistake it by looking at the kind of dollar liquidity that is sloshing around in all markets now, but that's not got to do with growth prospects. That's got to do squarely with the kind of change that we've seen in the mood towards Fed interest rates, where earlier people were talking about the number of interest rate hikes that might happen in the United States, and now they're talking about the number of rate cuts. That whole discourse has changed around, which is the source of the major dollar rally that we're seeing across the world. However, if you look at core economic growth prospects, which are a more stable long-term indicator of where equity markets will be and earnings will be, those are not looking particularly great, because the two engines of global growth, the United States and China, are both slowing down. In fact, the one very significant thing which has happened this week or a few days back is that there has been an inversion in the US market bond yield, which means that the 10-year yield has actually slipped below the 3-month yield. I mean, without getting into the technical nuances of that, basically why this is significant is that in the past, whenever there's been an inversion in the US bond yield, it has usually been a very reliable indicator of a US recession over the subsequent 1 year or so. And that is something which all economic commentators are increasingly getting worried about, on whether there will be a recession in the US or not. Now, we don't know whether that will be the case, but it is a given that, it is a fact that the US, China, and the Eurozone are all slowing down at a fairly alarming pace. The Eurozone is already perilously close to a recession. The US, for now, people think will get away with a slowdown, not a recession, which means it will continue to grow at, say, 1.5–2%, but not get into negative growth. And China will slow down quite significantly over the next 4 or 5 quarters. A combination of these factors might actually tip the world into a fairly sluggish economic mode, which has ramifications for India. So the two need to be looked at discretely. One, slowing global economy and its impact on India and Indian earnings, and dollar liquidity, which is being actually ushered in by the Fed's extremely dovish stance and talk about rate cuts going into the future. In March, we've seen FII flows which are the highest in the last 12 years in terms of a single month inflows, which is the reason why the index, the Sensex and the Nifty are trading nearly at all-time highs. We've seen enormous amounts of money coming because the dollar carry trade has resumed because of talk of US interest rates slipping and the Fed not tightening its balance sheet from here on. So the important thing to realize is, or the important question to ask is, whether we'll have a US recession or we'll have a US slowdown. And the impact on the Indian market might be quite different given these two scenarios. If there is a US recession, it might trigger off a global bear market in equities, and India will not be spared. So we need to be very cognizant of the numbers which are coming in, keep monitoring the US bond yield closely, and if that inversion deepens and more commentary and data points support the fact that we are slowly headed towards a US recession, then even Indian equity investors should start getting quite worried. However, if it turns out that we are not headed towards a US recession and we are only headed towards a slowdown, then it might actually conversely work in India's favor. Because say the US slows down to 1.5–2%, not a recession, and muddles along, then global investors will actually start to look outside the US for better opportunities for growth. And therefore, you might have a curious situation where the US is slowing down. It is not strong enough, that slowdown, to hurt economic prospects in emerging markets like India, and the dollars from the US market, from US investors seeking higher returns, actually moves to markets like India. So you could see more dollar inflows into India in the case of a US slowdown, not recession, which strengthens the Indian equity market and the Indian rupee, and India might actually outperform some of the developed markets quite significantly. So these are the two scenarios that are in front of us: a slowdown which might work in India's benefit or favor, and a recession which might actually destabilize sentiment enough to cause a global bear market where India will not be spared. This is a good question, because in a scenario where we know that US, China and the Eurozone are slowing down, investors have a choice. Right now, none of us know whether there'll be a global recession or not triggered by a US recession. You can take a guess, but the guess may be right or wrong. Right now, what investors can do is to work with the hypothesis that India's growth will pick up post monsoons, post election outcomes, and slowly earnings growth will accelerate in FY20. That's the base case assumption with which the stock market is working today. Within that context, we've got a global slowdown, and therefore investors in India can actually tweak their portfolio allocation to cut down some of their globally exposed stocks. If they believe that the US slowdown will get more entrenched and will get very close to recession, then sectors like IT, people might start to cut down exposure on, because IT will get hurt if the US gets close to a recession, because spending budgets will be cut. Maybe the same is true of pharmaceuticals. Not so true of chemicals yet, because the upcycle has begun again, but one needs to be cautious about chemical exports as well. And finally, there is autos, where auto exports, the real big player is Tata Motors, and we need to be cognizant of what is happening in China, and the exposure to Tata Motors needs to be tweaked accordingly. But short story, if the global slowdown becomes more intense, then sectors like metals, IT, pharmaceuticals need to be looked at very carefully, and maybe investors will want to be more cautious about these sectors in the year ahead. So where should the money go? The money should actually start to flow into some of the locally exposed sectors, and within that there is a feeling that since the Fed is not going to raise rates globally, this gives more room to even local central banks like the Indian RBI to cut interest rates further locally. And if an interest rate cut cycle actually deepens, then some of the rate sensitives in India will actually do quite well. So we know the interest rate sensitive sectors, they are banks, autos, real estate, etc. But also some of the industrials, because if the credit cycle picks up, then some of the industrially exposed sectors like cement might also start to stage a comeback after many quarters and years. So these are the broad ways in which a portfolio allocation can be tweaked, keeping the global slowdown or the possibility of a global recession in mind.